Hi all final year BCom students. So this is the third video of this series. Today we are going to discuss block number 2, important questions. So in this video we will discuss the important topics covering in unit 5, unit 6. Okay, so remaining topics of this block we'll discuss it with another video, right? So before getting into the video, as usual, just go through the content. If you like it, please like, share and subscribe the channel. Okay, and if you have any comments, please do post it. Okay, so without further ado, let's get started. Okay, so the first important topic is branch banking. So we know that different banking system came into existence with the development of banking in the world, and some of the important banking systems are branch banking, unit banking, group banking and chain banking. Okay, so there is an important question from this: what do you mean by branch banking, what are its advantages and what are its disadvantages? Okay, branch banking refers to that banking system in which two or more banking offices are operated under single ownership and management as a single institution, right? So thus, the business is operated by the head office through a network of branches spread in different parts of the world. So that is known as branch banking. In India, all commercial banks like SBI, then Bank of India, etc., all these are indulge in branch banking operations, right? So we know that HSBC, Barclays, then all these all are coming under branch banking. They have a head office, but they are operating through network of branches that spread across the world, right? So what are the advantages of branch banking? Economies of large scale operation. So branch banking enjoys advantages and economies of large scale operation because they are operating at different parts of the world. So it is one of the advantage. Economy of cash reserve. Under branch banking, a particular branch can operate without keeping large amount of reserve. Clear? So in time of need they can take the resources from one branch, they can transfer the resource from one branch to another. So that is another advantage. Then proper use of capital. So there is a proper use of capital under branch banking. Then risk spreading economy. So the spreading of risk geographically is another important advantage of branch banking system. If the loss incurred in one branch can be offset by the profit of another, right? Then easy and cheaper transfer of fund. Since the branches of banks are spread across the world, so the banking transfer, that is the fund transfer, will be a cheaper business, right? Then greater safety and liquidity. So branch banking also offers a wider scope for the selection of diverse securities and varied investment. Then balanced economy, that is under branch banking the bank facilities can be made available to almost all sectors of the society, and particularly in those who are living in the backwards of our country, backward areas in our country. So it is very helpful in an inclusive growth. Then convenient for central bank supervision. So in India we know that all the commercial banks are controlled by the RBI. So the central bank can supervise the activities of these all commercial, public and private sector banks, right? So these are some of the advantages of. Now what are the demerits of branch banking? So first demerit is danger of mismanagement. Second one, sometimes the delays in decision making. So that is red tapeism is there. So that is one of the reason. Then lack of personal contact. A large bank tends to become more and more impersonal because for SBI and all, they can't keep the they can keep a personal relationship with each of their customers. So that is another disadvantage. High operating and maintenance expense. Branch banking is very expensive because the opening of too many branches, establishment and maintenance charges of these branches sounds high. Then concentration of monopoly power in the hands of a few bankers. So we know that in India and all the currently the SBI have the majority of the share of banking system. Almost all public sector banks get incorporated there, right? SBI as a part of this disinvestment policies and all. So nationalizations of the banks happen, and after that now the banks are getting merging, right? So that is that can lead to a demerit, that is the concentration of monopoly power in the hands of few bankers. So these are some of the demerits. Now, unit banking. What do you mean by unit banking? In this type of banking system, independent isolated units perform banking system. It operates in a limited area. It has only branches in a particular area only. So that is unit banking. So advantages of unit banking: easier and effective management, utility for local development, and tackle the local problems. So unit banking means they have only operations in a particular area only, so that type of banking is known as unit banking. So disadvantages means lacks benefit of specialization and division of labor. Like in branch banking, they have a diverse workforce and they have enough talents with them, so they can manage it properly. So but that is not applicable in the case of unit banking. Destructive competition. So in this type of system there can be a destructive competition. Okay, so now group banking. What do you mean by group banking? It's a consist of ownership and operation of two or more banks directly or indirectly by a corporation. So the group is organized around a key bank, which is in turn is collected by a holding company. We discussed about holding company and subsidiary company before itself. So group means a particular group is having two or more banks, they are working together. Then chain banking is another form of group banking. It refers to a system where two or more banks are controlled by a single person or a group of persons through stock ownership. So two or three persons form a partnership and they are running a chain bank, so that is also chain bank. So these are some of the banking branches, right? Now, commercial banks. Commercial bank is a kind of financial institution which carries all the operation related to deposit and withdrawal of money for the general public, and it provides loans for investment. So these banks are profit making institution. The two primary characteristics are lending and borrowing. So the bank receive the deposit and give money to various projects. So the rate of interest that a bank offers to the depositors are known as borrowing rate, and while at the rate at which bank lends the money is known as lending rate. So these all are the basic things, you all know it. So now what are the functions of commercial bank? They have primary functions, secondary functions, okay, primary functions, secondary functions, and general utility services. So primary functions means it accept deposits, then provide loans and advances, credit cash. Okay, when a person then a customer is provided with a credit or loan, they are not provided with liquid cash. So first a bank account is open for the customer, then money is transferred to that account. So that this is the process allows bank to create money. So these are the primary functions. Now secondary functions: discounting bill of exchange, overdraft facility, purchasing and selling of these, locker facilities, paying and gather the credit. Okay, so there are three different types of commercial bank: public bank, private bank, and foreign bank. Public bank means it's under government control, that is SBI, Bank of Baroda. Then private bank means HDFC, ICIC, so that is in the private sector. Foreign bank means they are established in other countries, but they have branches in our country, so they are foreign bank. Example, HSBC, Hong Kong, Shanghai Bank, then Standard Chartered Bank, then Citibank, etc. are some of the examples of foreign bank. Okay, so we finished that important question: what do you mean by commercial bank? What are the advantages? What are the disadvantages? What are the functions? Then we discussed what are the types of commercial bank. Right, now creation of credit. Okay, so before getting into that, what do you mean by portfolio management principle? So the bank have to manage portfolio means assets and liabilities. So the bank has to manage their portfolio in such a way that the profit is secured to meet the expense, liquidity is assured to meet the demand of the depositors, and safety of the fund is assured, so that to ensure solvency. Okay, so that it is the duty of the bank to manage their portfolio in such a way that they have to secure the profit and they have to meet the expenses, liquidity should be assured, so that they can meet the demand of the depositors, and also the safety of fund can be assured to make sure that the bank is in a solvent state. So these are the principles of portfolio management. Okay, so we are going to discuss the bank concept of credit creation. So credit creation means expansion of deposit, and bank can expand their demand deposits as a multiple of their cash reserves, because demand deposit serves as a principal medium of exchange. So credit creation separate a bank from other financial institutions. So credit creation means expansion of deposit, right? So bank as a business institution, it tries to maximize its profit through loan and advances from the deposit. Okay, so we are going to discuss different types of um, different ways through which the bank is creating the credit. So bank deposit, so one is bank deposit means the bank deposit form the basis for credit creation, and there are of two types. So primary deposit and secondary deposit. Primary deposit means bank accept the cash from the customer and open a deposit in his name, so that is primary deposit. Secondary deposit means the bank grant loans and advances, and instead of giving cash to the borrower, so they will open a deposit account in his name, so that is known as secondary or derivative deposit, right? So we know that bank deposit, whenever we are saying about bank deposit, we only know that you have an account in the bank and you are depositing the money there, and it's a primary deposit. Okay, the second type of deposit is known as secondary or derivative deposit. That means if you're taking a loan from a bank, okay, so bank will not give you the cash in your hand. So what they will do, they will transfer that amount to your account. So you have to take an account, loan account in that bank. So that account is known as, that deposit is known as secondary or derivative deposit. Okay, then next way is cash reserve ratio. Cash reserve ratio is the percentage of total deposit each bank has to hold in cash reserve. So they have to, from the deposit, for example, I deposited 10 lakh rupees in a bank, so using my deposit the bank are giving loan. Okay, but it's a duty of the bank to ensure that whenever I am in need of my 10 lakh rupees, they have to give back. So what they have to do, they have to keep certain reserve for them, so that if so that they can meet their customers demand. Okay, so that is cash reserve ratio, the amount of percent of total bank holding. Okay, then excess reserve, the reserves over and above the cash reserve. So they have, for example, they have to keep 10 lakh rupees as the cash reserve, so they have 25 lakhs with them, so that is the excess reserve. Okay, so that is also used for loans and credit creation. Then credit multiple, certain amount of cash bank can create multiple times credit. Okay, so the demand deposits are one of the important constituent of money supply. So the expansion of demand deposit means expansion of money supply. So the entire structure of the banking is based on credit. Credit means you are getting the purchasing power now and you are promising to pay that amount later in future. So bank credit means bank loans and advances. When we discussed about the secondary deposits or derivative deposit, we discussed about an account. So whenever you are taking a loan from the bank, you have to make an account there. Okay, you have to start an account, that is loan account. So the bank will transfer the money to that account only, they will not give you that money in cash. Okay, so that account is known as the secondary deposit. So the loan is credited to the account of the borrower. Every bank loan creates an equivalent deposits in the bank. Therefore the credit creation means expansion of bank deposit. So we discussed which are the way through which the bank can create a credit. Okay, particularly through the bank deposits, there are of two type. Then the cash reserve ratio, then we discussed the then we discussed credit multiplier, right? Okay, now two important aspects of credit creation are liquidity and profitability. So the liquidity means the bank must pay cash to its depositors when they exercise their right to demand. So whenever the customers demand their money, it's the duty of the bank to provide them with the money. Okay, so that is liquidity. So then profitability, the banks are profit driven enterprises, so therefore a bank must grant loans in a manner which earn high interest than what it pays on its deposit. So always the loan, when we are taking a loan, the interest is high, but for the deposits we are getting only less interest rate for our deposits. Okay, deposit rates are less while compared to the loan interest rate, right? Okay, then Bank credit creation process is based on the assumption that during any time interval, only a fraction of the customers genuinely need cash. And also the bank assumed that all its customers would not turn up demanding cash against a deposit at one point in time. So that is the basics. So that means I deposited 10 lakh rupees, another person 10 lakh rupees, another person 1 crore rupees. Like many people deposited money in that bank. Okay, the bank know that all these people will come to and ask their deposit in one day. It will not happen. Okay, so only a fraction of the customers genuinely need cash, so they can use the remaining amount of money, keeping the cash reserve ratio, right? So that is the basics for this credit creation, right? Then there are two ways of analyzing the credit creation process. First is credit creation by a single bank, and second one is credit creation by a banking system as a whole. So first we are going to discuss the credit creation by a single bank. So in a single bank, one bank operate all the cash deposits and check. So let's assume that the bank requires to maintain a CRR of 20%. So they have for example 1 lakh rupees, 20% of 1 lakh rupees they have to keep as the cash reserve ratio, right? If a person A deposits 1000 rupees with a bank, the bank keeps only 200 rupees in the cash reserve ratio and lends the remaining 800 to another person. Okay, why? Because CRR ratio is 20% only. So 1000 rupees, for 1000 rupees it is 200 rupees. So bank keep only 200 rupees and remaining 800 they will give to some other person as a loan. So they open a credit account in the borrower's name for the same. So that person who are taking loan from the bank will start another account, that is a secondary account. Similarly, the bank keep 20% of 800, that is rupees 160, and advance the remaining 640 to another person C. So further the bank keeps 20% of rupees 640 and advance the remaining to the another person D. So this process continues until the initial primary deposit of rupees 1000 and the initial additional reserves of 800 lead to the additional derivative deposit of 4000. So when we add these derivative deposits, total we are getting 4000 rupees and the initial was 1000 rupees, that's a primary deposit. So adding the initial deposits, we got the total deposit as 5000 rupees. So in this case the credit multiplier is 5, that is reciprocal of CRR, right? That is 1 by 20. Okay, so that is 1 by 20 is in percentage 20%, right? That is 5. So and the credit creation is 5 times the initial excess reserve of rupees 800. So the creation is 5 times the initial excess reserve is 800 rupees. So that is 1000 rupees someone deposited. So the bank has to keep only 20% of that. So remaining 800 rupees is the excess reserve. So that excess reserve they have given to loan to another person. So that from the derivative deposit they will get a amount by adding up total they will get 4000 rupees and from the initial deposit 1000. So as a total it is 5000 rupees. Okay, total deposit is 5000 rupees, right? So the credit creation is 5 times the initial excess of reserves of rupees 800. Okay, that is the way the credit creation happening in a single bank. Okay, now the credit creation in a banking system. So in a banking system means they have many banks like SBI and all, and it cannot grant loans in excess of it cash it create. When a bank creates a derivative deposit, it loses cashes to another bank. Okay, for example, so in a multiple credit creation, for example, we can take that if a depositor deposit rupees 2000 rupees in a Canara bank, okay, and then cash reserve ratio is 10%. So bank can grant a loan of 1800 rupees. So for 2000 rupees 10% they have to keep and the remaining they have to give us the loan, right? So to a person by crediting the amount to his account, if that the person pay the amount of rupees 1800 to the supplier of the material by a check and the supplier of the material deposit that check in State Bank. So he give that so he took a the person taking a loan and he got 1800 rupees. Okay, so that rupee what he has done, he has give that money to another supplier by depositing that check in the State Bank. Okay, actually it's a Canara Bank, all this process started, but now it deposits in the State Bank. So the deposit will be 1620 after maintaining 10% cash reserve. Okay, so there the credit creation is goes on like that. Okay, so in the derivative deposit, the credit creation or the creation of the derivative deposit by the banking system will be like previously 10 times the credit multiplier, right? 10 times the credit multiplier. So the loss of deposit of one bank is the gain deposit of another bank. Okay, this transfer of cash within the banking system creates primary deposit and increase the possibility of further creation of derivative deposit, right? So these calculations are not needed, for your information only I told you, right? Then the factors that affect the creation of credit are capacity of banks to create credit, the willingness of the banks to create credit, also the demand for credit in the market. Okay, so the capacity to create credit is a matter of availability of cash deposit with the bank, factors which determine their cash deposit ratio. So when we know that the bank has a capacity to create credit, the availability of cash deposit with the bank, so the factor which determine their cash deposit ratio. So as a regards the demand for credit, demand must exist in the market. Currently the demand is less. Currently demand is high because people don't have money with them, so they will took the loan, and that's why the government is providing home loan at very lowest rate, right? Credit worthy borrowers to avoid bad debt. So one of the demerit of these types of loans is that because when interest rate is low, people will take the loan, but it can lead to bad debts also. The amount of loan granted should not exceed the paying capacity of borrower. So that's why the bank used to keep certain limit for that. So if you are throwing a salary of this much, you will get you are eligible only to take a loan up to this much amount, right? So that is another thing. Leakages in economics, a leakage is a diversion of fund from some repetitive process. If the banks are unwilling to utilize the surplus fund for granting loan, then the economy is heading towards recession. So bank is not ready to utilize their surplus fund, so recession will happen. Recession means the money shortage. Okay, if the public withdraws cash and hold it with themselves, that is, it reduces the bank power to create credit. Okay, so I have 10 lakh rupees or 1 crore rupees in a bank, so I uh, withdraw the money, and money is with me now, so I'm not depositing it again. Okay, similarly this many people are doing it. It can lead to the it can reduce the bank power to create credit. When we are making the deposit, bank will create the through our deposits only they are creating the credit, right? So this is the way the banking system is run. So that's the end of this video. We covered almost all the important topics from unit 6 and 7 of block number 2. Okay, remaining topics of this block will be discussed in another video. Okay, so today we covered what you mean by branch banking, unit banking, group banking and all, then the advantages, demerits, functions of commercial banks. Then another important topic is credit creation, how the credit creation happen in banks and how the banking system is operating in our country, different types of banks that are present in our country. All these things we discussed through this video. I hope these information are valuable for you while preparing for the examination. Okay, so if you like the content, please like, share and subscribe the channel. Your comments, your subscriptions, your likes are actually a boost for us for making more videos. Okay, so see you with next video. Until then, it's bye. Thank you. Take care. Stay safe. Stay healthy.